Hi, everyone, and welcome to the Executive Espresso Break, the caffeinated edge for scaling success. I'm Sam Palazzolo, and I want to welcome you to this special episode where we'll be diving into the critical finance and capital strategies that CEOs need to scale their businesses effectively. We're going to cover how to make smarter capital allocation decisions, master cash flow, and even discuss when M&A might be the right move for your growth journey. So, whether you're running a startup, an SMB, or a Fortune 500 organization, this conversation is packed with insights that you won't want to miss. So, let's get into it. This is our agenda today. Again, we titled this The CFO Strategies for Scaling Success, and we're going to cover four broad areas. The first, CFO perspective on scaling. Second, capital allocation and ROI-driven growth. Third will be cash flow mastery and working capital optimization. And then we'll bring it home with that fourth section, M&A as a scaling strategy. I'm joined by Mr. Matteo Turi. I'll allow him to take some time, introduce himself, and then I'll introduce me because you're probably wondering, who are these people and how can they possibly help us? So, Matteo, take it away. Introduce yourself.
Okay, so first of all, thank you so much for having me today. I have been a CFO for the last 17 years, primarily in a number of industries, but mostly lately in infrastructure, like renewable energy, clean technologies, also water sector. It's been in a number of situations, ranging from startup to scale up to eventually exit situation, but also crisis management. And today I'm very pleased to be able to tell you about my experiences. In fact, there are so many situations they can experience in business, and there's never going to be a book that's going to tell you what to do because it's all about the situation in which you're in. So yeah, it's a pleasure for me to join you, and back to you, Sam.
Yeah, no, I love it. Real strategies, real solutions, and results. That's my tagline. Again, I'm Sam Palazzolo. I'm a managing director for an investment bank where I specialize in M&A, but I'm ex-Deloitte, and I run a business scaling consultation and coaching practice where I help leaders take their businesses. I've taken them from $10 million to $1 billion and beyond. So my pleasure to be with you, and thank you, Matteo, for joining me today. I do want to make this offer to you. It's our 2025 Executive Espresso Strategy Session. I offer these, think of it as an executive briefing. In 20 minutes, you and I will connect, audience member, and identify your most pressing opportunity, discover the true cost associated with those opportunities, and we'll drive from what the opportunity is all the way through action plan in 20 minutes. I'll also share our 2025 scaling programs, and I'll tell you a little bit more about that a little bit later on. But Matteo, let's get into it. I encourage everybody, grab your cup of espresso and hold on tight because our first item that we're going to talk about today is the CFO perspective on scaling. Matteo, let's start with the big picture. Scaling a business isn't just about driving growth, it's about ensuring that the financial foundation can support growth. I wanted to find out from your perspective, and it's our first question here, what are the most common financial blind spots that hold companies back?
Yes, I will start with the perspective usually, business wide. Yeah, generally speaking, when you scale a business, it's an exciting moment because the market has accepted your product. So it's really time to execute. So unfortunately, this is where we see lots and lots of business failures. So the question is very pertinent to a number of situations I've experienced in the past. So to really make it simple, a business should be doing three things very well. Number one, sell, obviously. Number two, produce. But number three, the most important is to generate cash flow. Generate cash flow is the ultimate goal. As a talking point, in this situation, the CFO should really advocate for dynamic financial models because you have to adapt to a scaling reality, which is not really written on a book, as I said. It's a reality that is learned day by day. And it needs to really encourage investment in systems that provide real-time insights. You don't want to be late to the game, in a few words, yeah?
Yep.
So what are the yeah, I don't know if it happens to many of the people who are watching us here, but you just want to be really, you want to anticipate the question. You don't want to wait for the question to be asked, really. So financial blind spot, you tend to have cash flow mismanagement. Now, generally speaking, companies underestimate how scaling can increase expenses like hiring, production, marketing before revenues catch up. And I've been in that situation so many times where I really was putting a brake on recruitment, putting a brake on marketing expenses before the business was going to realize its full commercial really potential. And sometimes I was sitting in the board of directors and telling them, we're not spending as much as we budgeted. Why? Because it's discipline. First, we want to make sure the commercial activity is going really well. The other problem is underestimating operation costs. Now, usually business overlook rising costs from logistic, infrastructure, system upgrades needed to handle growth. Yeah, because again, each situation is unique. And this is why, again, discipline is really paramount. Scenario planning. Normally, we require to be flexible on this, but we need to have at least 3 scenarios. We need to have a best case and worst case. Even if you're a startup or an early stage business, you need to do those stress tests. You need to ensure that the business can really survive any situation where, for example, you might lose one particular customer that you rely too much on. Misaligned metrics. Sometimes companies rely too heavily on revenue growth. They just bet on growth, and the bet is too dangerous sometimes. So ignore profitability or efficiency ratio. Example, a SaaS startup rapidly scale its user base, but failed to foresee rising server costs, which eroded margin. Last but not least, the big mistake I see a lot of times is the customer acquisition cost versus the lifetime value of the customer. If the customer acquisition cost is higher than the margin you're making on a customer on a lifetime value, you're instantly losing money. You're instantly betting for failure, effectively. Hope that gave you a bit of an idea. Obviously, there are so many cases, but I just gave you some ideas, okay?
No, it's great, great insight, great overview. It takes us nicely into the second question here when it comes from the CFO perspective on scaling. How do those differ between early stage growth companies versus mature enterprises?
Yes, this is where effectively a good CFO needs to be really good for any season. It could be spring, summer, winter. You need to understand where you are, what business stage you're in, because maturity stage is not the same as a rapidly scaling business. So the CFO roles can shift from a survival mindset in startups to an optimization mindset in mature businesses. So you require really a tailored strategy for each phase. Yeah. Now, some of the blind spot I told you before, you also find them in this situation. But what's one of the most recurring issue with early stage companies? But basically, the challenge is differently. Basically, the challenges are you have to focus on achieving product market fit. Because you're new to the market, you really have to start gaining market share. So it's important to do that. And most of the time, businesses, they really underestimate the importance of financial intelligence to a business. Now, pricing strategy is not just a commercial decision. It's also a financial intelligence decision. As I said before, if it costs you too much to acquire a customer, then you should not go out with that customer unless you're going to have, it's going to give you some other opportunities to develop other revenue stream. Now, the other big issue is not chasing more than one revenue stream. So sometimes you'll find businesses chasing one revenue stream, one customer. That's a risk. And discipline on risk management is where the CFO should always be absolutely on top. Now, this is where even if the CEO, even if the shareholders are not particularly disciplined, the CFO is absolutely responsible. So what I would say is if it's not written in your job title, it doesn't matter. It's your job. You have to anticipate this issue. So that's the way I would really establish any kind of CFO sort of position to be filled. Now, mature enterprises, it's a different world, yeah. The challenges are about resource optimization, cost control, managing legacy system. What you find normally in a mature business, the risk is obviously relaxation. For example, thinking that a customer that has been your customer for the last 10 years
Mhm.
will continue to buy from you. So one of the biggest issue is really, it is potentially lack of innovation. So you need to keep innovating. You need to keep really ensuring that your customer is happy with your product. And you need to do all you can to extend the lifetime value of your customer. An example is sometimes you may find that businesses, they are better selling to existing customer than acquiring new customer. Now, if that's your strength, then you invest in that strength. Don't invest in new customer, or not as much as you would by extracting more revenue from the customer. Obviously, each situation is different, but I just wanted to give you a flavor.
No, it's great perspective. Traditionally, we think of the job of customer success or customer retention to be that of the sales department and or marketing, right? To go make certain that we're getting the right customers with us in alignment so that way they stay with us. But the vantage that you just shared from the kind of CFO perspective, the accuracy with which you're extending capital, cash flow guidelines, mitigating risk, all of those things hinge on customers, which typically goes back to the nothing happens till you sell something, but it's a wonderful role for the CFO to take in perspective to help with accuracy attempt to identify how long customers are staying with us and why would they stay with us from an innovation perspective. So unique perspective and key distinctions also between not only those blind spots as well as how those things differ between where an organization's at along its life cycle, right? Early stage versus mature. So very interesting. Let's get into our next topic here. Because when I think a little bit about optimization, one of the biggest challenges leaders face is knowing where to invest for maximum impact. Capital allocation is both an art and a science. So, Matteo, I was wondering if you could maybe take a minute here or two to discuss what frameworks or financial metrics you recommend CEOs use when making capital allocation decisions.
Yeah, I will start by telling what the CFO role should be to help really the CEO achieve the right objective. So really the CFO should be really the champion to ensure to have frameworks, yeah. So
Mhm.
sure, every dollar is tied to a strategic goals or a measurable outcome, yeah, really. And again, this is where discipline really reigns, shall we say, yeah. For example, return on investment and payback period, yeah. Now, a business is a countless sequence of trade-offs. There's not such a thing as, okay, I like to do A and B and C. Sometimes you have to do A and then you can do B and C. Or sometimes you have to do A and postpone B. So that's the kind of situation which are in, which is why communication absolutely is essential. And investor relation as well is obviously essential. Now, we could go from one end to different type of situation where a business might have capital requirement to capital generation. So when you got a company that really generate lots of cash flow, then you could have the opposite problem. How do you buy back shares, for example, so that you increase the share price or the value of each share, for example? So that's so many different situations here. But I would say definitely the framework to prioritize capital investment will be return on investment and payback period. Again, they are very important. They are really objective. They are mathematical. They are not really 100% of the decision, but they should really drive the decision. Now, what about risk-adjusted returns? Because a business will start with risk. The business will start with risk forever. So there's never going to be a business without risk, yeah?
Mhm.
So the returns should be adjusted against the risk, really. Say, if you are able to invest in something that gives you 9% without risk, why should you invest in something that gives you 9.5%? You have to take the risk. I know this sometimes may sound really logical, But sometimes, yeah, you do have that, especially in small situations, small businesses, that situation, those situations need to be explained a lot better and for longer. Now, what about balanced scorecard approach as well? Yeah. So align investments with strategic objectives across finance, operation, customer value. Again, the example I did before about are you going to invest in acquiring new customer if you're not very good at acquiring a customer, or you're going to invest in a certain period of time in creating new revenue streams, or maybe it's doing some R&D because R&D is going to give you innovation regardless of which stage you're in, for example. Yeah.
Mm-hmm.
Now, the other thing I would really advocate a lot in many businesses, regardless of business stage, it's zero-based budgeting. Now, zero-based budgeting you don't hear too many discussion about zero-based budgeting, but zero-based budgeting has got so much merits because it really gives you that kind of discipline you need to really allocate capital in the right manner. You need to reassess all expenses, allocate capital based on current priorities rather than historical patterns. Because what we see most of the time is, okay, we've been spending money on this, we can't stop it, but it's not generating any returns, so you should stop it actually.
Mm-hmm.
So again, this is where the CFO should have sufficient personality as well sometimes to say, we should stop this because it's not generating a return. Even if we committed money with the budget, but the reality is different. That's why I was saying the CFO should always invest in system that will tell you what the reality is, because it's just too easy to say it's in the budget, so I should spend it really.
Yeah, as you said, it sounds very logical, and on paper, it seems to work out illogically, or maybe when you
Yeah.
get people involved, right? Which brings us nicely to the second question here. What about common mistakes? I know you've seen companies allocate capital to initiatives that seem promising but didn't pan out. How can leaders avoid pitfalls like that?
Yeah, I would say it's about really having the right mindset towards the real objective eventually, which is a cash flow and then profitability, shall we say, yeah?
Yeah.
I would say this, most of the pitfalls we've seen, chasing growth instead of profitability. Okay, it's a trade-off, yeah. It's a trade-off. It's usually a negative trade-off, but some companies, they actually do it. They invest heavily in scaling before achieving operational efficiency. And this can lead to unsustainable losses, yeah, because you don't have the capability to recover from this situation, really. Then there is, in some situation, not a very good way to review the investment. So that's a poor pre-post, there's a poor post-investment review, really. What about monitoring better the effectiveness of that investment? So,
Hmm.
because at some point during the investment, say you got an investment for 5 years, you might need to pivot after 2 years because it's not working out the way it should. So, how do you A, monitor, and two, really have the strength to make that decision? So it's about really a very strong mindset towards really chasing what is really best for the business. And sometimes it's about really overlooking some hidden costs when you allocate capital.
Hmm.
For example, some deployment plans I've seen often underestimate integration, operation costs. I'll give you an example. A retail chain expanded to new markets, failed to account for cultural differences. So they had unprofitable stores. Yeah. So before you actually make a decision, there's so much more than just number. You need to understand really where you're going to go to. Say, if I go into a country in which I haven't done enough marketing studies, and again, marketing is one of those big pitfall here because when you decide to capital, there's confusion here. Marketing is the study of supply and demand.
Hmm.
And unfortunately, there's not enough study done. So you may do a capital allocation and then say, I'm not making any money. No wonder you haven't done your marketing studies. So that's one of the situations I've seen, yeah.
Yeah, no, I've seen those marketing studies, even at a complete level, where you would think that every risk feature has been taken into account. The market shifts. the economy shifts, customer preferences change, those types of things. You mentioned a couple of times a little bit about cash flow. So let's slide into this next section here, talk a little bit about cash flow mastery and working capital optimization. Uh, these are topics that every CEO needs to understand, and really every leader or leader mindset within an organization. I know that in our consultation efforts, I spend a lot of time focusing on capital and cash flow. So I was hoping that you can distill any myths, maybe talk a little bit about cash flow and how it can make or break a scaling effort. What, from your perspective, do you see are the key cash flow principles that leaders should follow to ensure their growth is sustainable?
Well, cash flow is probably one of the biggest topic that is discussed, but it's one of the least practiced in business, or at least one of the least practiced as well as it should be. And unfortunately, whether we like it or not, cash flow is the dominant reason for business failure. And this is so painful because sometimes you have a profitable scale up that fails because of the cash flow. How painful is that? You got a problem in the market, you got employees, you got jobs that you're going to lose, you got innovation that you're going to lose. That cannot be, I don't think there can be a much worse situation in business than seeing a profitable business failing because of cash flow.
Right.
So it's really, I don't think CFO ourselves, we're doing enough to educate really about this. We should do so much more, yeah. So really, CFO should instill a culture of cash consciousness, really. So you need to implement the tools to provide visibility into working capital. Now, the key word here is visibility, because the business is like a river that flows. So it never stops flowing. So when I see all these reports sometimes about profitability, what's the P&L this month, what's the gross margin, what's the net margin, and etc. My next question is, okay, can you show me the conversion of margin into cash flow? Say, if your business is generating a profit of $100 in 1 month, but then the cash flow generation is 10, that is very poor. So there should be a monthly sort of monitoring of that. And even big businesses, they don't do it. So it's about really big, small, large businesses. Now, accurate forecasting. Now, forecasting is you are effectively like a dog with a bone, effectively. So 13 weeks cash forecast is what I really advocate to any business. Now, some businesses, they might need daily cash forecast, some retail, for example. But I would say weekly is a good way to implement cash flow discipline. That will ask all the questions every week at least once. And will allow really the business to have visibility. Visibility is absolutely important, yeah. So understanding the cash inflows and the outflows. Now, this is part of a bigger plan. Obviously, we're going to have the 5-year plan, you're going to have the annual budget, you're going to have the refocus, but cash flow really should be on its own a focus that should be there at least once a week, if no more. The other thing I would say is, again, over-optimism when running a business. That's where you go a negative surprise. What if, for example, you rely too much on one customer? Now, that should come out of the cash focus as well. So you should break down your inflow customer by customer, understanding, am I really going to depend too much on the customer? Is my next cash inflow for the next 3 weeks depending on one customer? And if that customer doesn't pay me, I'm going to have an issue with the payroll. So these are really very common situation, unfortunately. I've seen it happening, even yesterday I saw it happening, so it happens every day. Now, the focus should be on operational cash flow. It really should prioritize liquidity over accounting profit. This is very important, especially in a fast growth scenario. I'll give you an example. Yeah, a manufacturing firm underestimating the cash flow gap caused by longer customer payment cycle after scaling. So when you scale, it's a different situation, of course, because scaling is different than stagnation, for example. But when you scale, your balance sheet has to grow. There's no question about it. So the capital has to grow as well. So you have to anticipate this. Active conversation with banks, active conversation with the investor, active conversation to finance your inventory, active conversation to finance receivable. If you are a SaaS, for example, you can go to special financial product to actually finance in upfront your SaaS revenue as well. There are so many ways that the key here is really discipline.
Yeah, it's almost like what I'm envisioning as you were talking was this is a CFO superpower that
Mm.
you're attempting to distill or to have other organizational leaders really be able to have similar superpower. Now, you hit on several things here. The second question, are there specific strategies CFOs use to optimize working capital without sacrificing growth? You hit on a couple of things in answering the first question, like educating CFO as educator to attempt to, with clarity, dispel any myths about cash flow and capital optimization. You talked a little bit about from a strategy of just making certain that we have accuracy of the numbers, right? From a quality of those. And more importantly, quality within the forecast by conducting weekly audits, for example. You talked a little bit about, well, it's not the CFO's role to play optimism crusher.
Yeah,
Their
absolutely.
role to almost play devil's advocate into just to get a gauge on risk. And the last thing, the extreme focus on cash flow. Um, are there any additional strategies as I just recapped what you were sharing in your answer to question one before we slide into the next topic here?
Yeah, I've actually anticipated so much about working capital as well. I would say this, CFOs who may be too busy doing cash flow focus, recruit somebody really, like
Yeah.
a treasurer or the controller can do it as well. Really, the talking point was this one. The CFO can drive growth, yeah,
Yes.
by ensuring liquidity, by balancing operational needs with disciplined working capital management. Now we can go into a specific situation, accounts receivable, payable, negotiate supply terms,
Mhm.
scoring suppliers, scoring customer, implementing dynamic really solution as well. You could incentivize early customer payments, but there's always a trade-off. What I would say always is trade-off is every day in a business. So make sure you're educated about trade-offs. Yeah.
Yeah, it's almost like contingency planning, right?
Yeah.
Let's figure
Yeah.
out what can work. And then Murphy's Law comes into play. Anything that could go wrong typically does. So, how do you react when that occurs? Let's slide into our final section here, which is M&A as a scaling strategy. We often view M&A as the fast track to growth. In my business scaling practice, we spend a lot of time identifying and analyzing five primary pillars within the business. One of those pillars, go figure, capital and cash flow. We also analyze 90 pylons that help support those five pillars of growth. But even if you fine tune the organic scaling initiative, you're looking at a multiple from a scaling opportunity 2x, 5x, 10x, so on and so forth. I've always said that if you want to achieve the exponential pop, if you want to go to a raise to the second power or third power, you've got to explore some M&A, either merge or acquisition. And I know M&A brings on a whole new set of challenges, specifically from the CFO chair. So I'm wondering from your perspective, what financial indicators should leaders look for to know if their company is truly ready for a merger or acquisition moment?
Yeah, when you deal with an M&A situation, you actually have to effectively you have to, well, you work for your company, of course, but you need to almost imagine that if you're working for two companies, because so you can apply the indicator to your business, but you need to apply the indicator to your business as well.
Yeah.
My suggestion is for the business that needs to acquire, really establish some real vision about liquidity readiness, measurement of liquidity readiness. Yeah. So what are the financial signals of readiness? Yeah. A consistent positive operation cash flow, absolutely. It demonstrates that you can fund an acquisition. So you're not going to jeopardize the core operation, are you? So you got sufficient cash reserves. So a strong liquidity ensures flexibility, structure in the deal, of course, yeah. Now, healthy free cash flow margin. This is where sometimes the FCF is not well sort of studied as much as it should be. So can you absorb the acquisition-related costs without financial strain? Yeah.
Mhm.
So that's definitely one. I would definitely look at that inside. Now, what about the business that needs to be acquired? Does he have a strong EBITDA, for example? But some people, they get blind when they look at the EBITDA. They say, oh, they got a strong EBITDA. Okay, what about the free cash flow? Because EBITDA is not free cash flow. So sometimes we have this lack of sort of analysis that is quite surprising at high level because especially for small businesses, they would require so much more education about these things because many small businesses could actually grow by M&A. Say the so-called boring businesses like security business or fire and security, health and safety, you got a big opportunity, you got a good balance sheet. We need to be educated about these things really. So the market readiness is also important because let's not forget, when you are doing M&A, you are obviously looking not to grow really. You have to look for that for a situation where every dollar spent should really generate the right type of return. So that's absolutely essential. So some financial signals of readiness, steady revenue growth, year on year, 10, 20%. Are you growing your market share in your core business? And now you're growing better than your competition. Do you have a strong argument against competition? Customer revenue diversification. So this is some of the situation. There are obviously lots of red flag, yeah, to be considered whenever there's an M&A activity to be done. And so, but those are obviously, for example, situation where there's high leverage, for example. Say, if you try to acquire a business with high leverage, you take on lots of debt. It doesn't matter that you got a good EBITDA. So, for example, say you got a weak interest coverage ratio, or you got you got situations where you should really think twice before making an acquisition. Obviously, M&A is such a vast, that we could go on and on talking for a long time, really.
No, I think you're right. It's one of those, what's a financial indicator? I think the financial mentality along with the indicators is important because if you wait until the moment is perfect, if you want to get everything in place before you're ready to take on M&A, I would venture to say that you're going to miss out on some opportunities because you know how it works with opportunities, specifically when it comes to M&A. A lot of it is luck, talent, and timing. Sometimes you can press luck or make luck occur, but my capstone of what you just shared regarding financial indicators, if you're waiting till everything is perfect, very rarely will everything ever be perfect, which probably brings us to a nice second question here when it comes to the topic M&A as a scaling strategy. There is probably one mistake that you see occur time and time again. Maybe it is very obvious, but maybe it is one of those things where it's under the surface layer, but it becomes relatively obvious relatively soon. Follow-up question: what's the biggest financial mistake companies make in the M&A process?
I would say I would name a couple of them, but the most obvious one is overpaying. Many companies overestimate synergies or fail to account for integration costs, eroding shareholder value. That's very common, unfortunately. But that leads me to the other mistake, which is insufficient due diligence, effectively. You don't want to skip in the financial and operational review, leading to unforeseen liability risk. This is where, for example, I was in a situation quite a few years ago. I jumped in the mid of a due diligence, and we found a hole on the balance sheet related to double payments. It was actually a retail banking activity.
Hmm.
So a million, a hole in the balance sheet. We found there was not an asset that was stated midway through the due diligence. Now you can imagine what happened with that, because when you find those issues, you then need to dig deeper into the IT audit. So you start with the financial audit or financial due diligence, and then you have to do an IT audit. Yeah. So we have to ask for a discount, obviously, on the acquisition. Now, the other non-financial problem which causes financial issues is the cultural misalignment. Now, when you ignore differences in company culture, can really undermine the success of the deal. So I'll give you an example. A tech company acquired a smaller firm for its IP, but underestimated the integration cost, which delay return on investment by a couple of years, for example. So yeah, there are M&A is such a vast situation. It's probably, I would say, where small businesses need the education the most, because that's where there's a lot of hidden value that can be potentially earned. With small businesses, they can actually multiply the valuation with M&A, really.
Yeah, it's fascinating to hear you say you gave us a top three biggest mistakes. The first one, overpaying, never a good moment, right? The second one, insufficient due diligence. It's one of those you've got to not only do the due diligence, but you have to verify the source associated with the data that you're looking at. In this instance, financial data. The double payment or the double opportunity that you identified, that's a great example. And the third one that you mentioned, this is one that we rarely think of from the CFO chair, and it's the cultural alignment involved with M&A. So if you could almost put a price tag on the culture or what applies some type of a weighted average towards how it is that the organizations are going to behave in a post-merger integration, the cultural misalignment, I have seen it where it's an absolute killer. So for the organization. So no, great recap there. Let's bring this home. Because again, I want to make everybody the opportunity to participate in a 20-minute 2025 executive espresso strategy session. Again, we're going to identify your most pressing opportunity, discover true costs associated with it, and drive towards an action plan. And we're going to do that all in 20 minutes. I'll also share with you a couple of our 2025 scaling programs. We've got a CEO Catalyst, which is all about the leader, all about the leader. Either whether you lead an organization or department or just yourself, the CEO Catalyst is designed to help you lead yourself, lead your team if you have one, and really scale your business. So the CEO Catalyst, we have an upcoming cohort. You can check that out in the link I'll put within the show notes here. Following that, we're going to have a business catalyst. This is all about scaling the organization. I mentioned we do a quick readiness assessment whenever we take on a new client. It covers five primary pylons, five primary areas, I should say, or pillars of the business, 90 pylons supporting those five pillars. It's a deep dive into identifying what should we work on and what priority. So whether the CEO Catalyst is right for you, the business catalyst, we got a request to follow it up with a specific M&A catalyst. So look for those programs to be coming out this year. Matteo, let's bring it home here. It has been a pleasure having you with me today. Great conversation. We covered everything from identifying financial blind spots and optimizing capital allocation to mastering cash flow and understanding the right time for M&A. How can our listeners, those viewing this video, how can they get a hold of you?
Thank you, Sam. I've actually created in January a new newsletter, effectively called the Exponential Blueprint. Now, this comes from my team program around with the Plymouth University. It's about giving a recipe to entrepreneurs, really, because most of the time, the knowledge about blue chip organization, the way they are successful, the way they do business, like the big success, Apple and Amazon and Microsoft, and all the ones that we know about, they are not very well shared across the entrepreneurship community. And so it's about providing more education. But the financial newsletter is unique for one reason. It's obviously a financially inspired newsletter, but it's about wealth creation. So it's about the various way in which an entrepreneur can increase value beyond finance. So it's called the Exponential Blueprint. And on my LinkedIn profile, people can subscribe easily. It's obviously free. It's every Wednesday. And if you want to know more about me, there's also a web page that, again, can be visited. It's called www.matteoturi.com, effectively. So that's another free source of information from me.
Excellent. Yeah, and we'll put those links in the show notes. Again, for our listeners, remember, finance isn't just a back office function. Hopefully that has come through crystal clear for you today. think of it as a strategic enabler for scaling success. And again, just to recap, if today's conversation sparked something for you, check out our programs. Check out Mateo's Blueprint programs, my Catalyst programs, where we take these concepts even deeper. Thank you again, Mateo, for sharing your expertise. And to our audience, I hope you've enjoyed this executive espresso break. Stay caffeinated, stay focused, and until next time, keep on scaling.
Thank you, Sam.
Thank you.